there's definitely a recognition from the Europeans that they're going to have to do more in their own backyard. So I think, particularly given the geopolitical environment and some of the politics that's sort of flying around, Europe is refocusing on resilience and trying to focus on kind of how do you maximize and build resilience. And as they do that, they're also sort of recognizing that that requires capital. And so I think, as you talk to the big European pension plans and insurance companies, they are all much more focused on how are they going to allocate capital to Europe versus North America over the course of the next few years. And that's a big difference, right? I mean, if you wound the clock back 18 months to kind of pre-election, almost all of the allocated capital has been focusing on North America. How can we get more exposure to that kind of growth thematic? That has changed radically over the last 12 to 18 months. And I guess they're starting to think, okay, how do I figure out how to allocate incremental capital? I don't think they're selling assets, but they are very focused on, well, if I've got an extra dollar to spend, I should really be spending that back here rather than over there. I think if you look at what does that mean in terms of flows for us, that'll be a huge net positive just on its own. I think you get sort of similar themes coming out of the Middle East and Asia, if I'm honest. The politics in North America, I think, has made it hard for people to thump the table, and particularly, also asset valuations, the inflation outlook, all that's making it a little bit more challenging for them to incrementally allocate to North America. And when they look around the world, if they're not putting money into North America, then Europe is probably the most logical choice for them. And as long as Europe pursues the right kind of supportive growth policies, I think that will just build up. So there's a lot of positivity building about Europe. I think the big challenge for a lot of them, though, is just this whole kind of issue of they put a lot of money out in 2017, 2018, 2019, 2020. And a lot of what they've got to invest for the next 5 years is really about getting money back from things they invested in 5 years ago. So I think for a lot of them, they've got to start to see money coming back in to the pot before they start to really ramp up their deployment. So you're getting an incremental dollar, but you're not really getting the benefit of that recycled dollar. And like I said, these guys upped their allocations and spent a lot of capital between 2015 and 2020. So giving them back the money that was raised in 2015 and 2020 is only going to be net positive for the industry as a whole, fully accepting that it's going to create some pain along the way because not everybody wants to get rid of assets that they bought in 2020. But I think that's going to be the key thing, is kind of switching that capital flow back on again. But look, I think they kind of recognize the investment opportunity. They recognize Europe's kind of taken a little bit of a step forward on growth. And they recognize that the US is probably a little bit more challenging for them to invest in and feel comfortable about going forward. And so I think Europe has kind of got a moment, right? It's got a window where it can try to take advantage of that. And it's just up to people like us to go out there and kind of thump the table a little bit and tell them that, there is a positive growth story here. The cycle's reset. There is an investment opportunity. You can exploit it. You just have to figure out who you want to give the money to and what those people are going to do with it, and what the best allocation of capital is.